Welcome to everyone that's tuned in. I'm going to give it about a minute or so, maybe 1 to 2 minutes, and let people trickle in, the attendees trickle in here, and then we will get started. I'm really looking forward to this. And while I'm waiting on people here, I'm just sort of checking to make sure we have connectivity across all the platforms that we're streaming on. We're streaming across LinkedIn, Twitter, as well as YouTube and Facebook. So I'll give it about another 30 seconds or so, and then we can get started here. Again, thanks for everyone that's joining in here. So I'm going to get started here in a moment. This is another round of an AMA that I've been doing once every couple months, CryptoCPA AMA, where I'm asking you guys to send me your most pressing questions, the questions that are most top of mind to you as Web3 CEOs, digital asset investors, Web3 CFOs and CPAs. What is top of mind? What do you want to know more about? And I have a whole list of questions here that you've sent me over maybe the past 3 or 4 weeks. And there's a lot of different areas that we're going to cover here. I'm not sure if we're going to get to all these questions, but this is what I want to focus on today. But anyone that is watching this live, I also encourage you to drop some questions onto this live stream, comment below. And if you have follow-up questions or if you have any questions that are top of mind that you haven't sent me, I would love to answer those and get you some answers here in live time as well. So we're going to have a lot that we cover today, and I'm really excited to get into it. So I think we've given everybody enough time, and I think we can get started here. So my name is Patrick Camuso. I'm the managing director of Camuso CPA. We work directly with both digital asset investors and Web3 companies on taxes and accounting. I'm also the host of The Financial Frontier, which is a weekly podcast that covers tax, accounting, and regulatory topics related to Web3. So again, what we're going to go over today are some questions that I've had people send to me either just through my personal profiles on social media, through my podcast on the Financial Frontier, as well as through my newsletter, the Digital Asset Digest. So one of the first questions that I have here that I got actually from a couple people is to explain the crypto tax court case that I have recently posted about, both in my newsletter, the Digital Asset Digest, and I also believe we covered this on last week's podcast as well. So basically, what we're seeing is the first indictment from the Justice Department on a individual named Frank Algren III. I think that's how you pronounce his last name. But basically what he's been indicted for and what he's accused of is misreporting his tax returns for several years. Now, keep in mind, I don't have the full tax court case in front of me. So several years, I believe it was somewhere between 3 to 4 years, where he misreported his capital gains. Now, the information on this hasn't went into granular level of detail, but what I've been able to learn about this is that he was basically overstating his cost basis information and or just not claiming proceeds that were related to sales of his Bitcoin. So, he was, some of the transactions he was claiming them on his Form 8949, but he was reporting a higher cost basis than he is able to substantiate to the IRS. And basically now he's been indicted for tax evasion, and he's facing somewhere between 3 to 5 years for each count of filing tax returns inaccurately. And again, he's looking at like 3 to 4 years of tax returns. So this is the first case that we've seen like this, and I expect that this case is, going to get a lot of media attention just because it's really the first of its kind in this regard. And I think that this is going to be a broader trend that I've also been predicting now for some time. I mean, going back to content I was doing all the way from the 2016 to 2017 era, I was trying to warn people that we are eventually going to see IRS tax enforcement, and all these transactions that are on a public immutable ledger are going to be open to scrutiny in perpetuity, especially if you're significantly underreporting your returns or committing fraud. And more recently, last year, we have seen indications from the IRS that they are going to be ramping up their criminal tax enforcement efforts related to cryptocurrency. So I've been sounding the alarm on this, and I think this is going to be the first of many cases that we see this year. We're going to likely see a lot more of this. And of course, it's going to be, bad for the taxpayers that get ensnared in this, but I do believe that it's going to also help raise awareness overall and have people realize, there are consequences to not reporting this. The IRS is able to track these people down, and it makes more sense if you want to protect your assets and build long-term wealth to actually file accurately. So we're going to continue to follow this court case and see what the ultimate result of this is, and just keep an eye on this overall, because I think this topic is just going to continue to increase in the future. So another question that I have here, and again, if you have any questions that are top of mind now, feel free to comment on LinkedIn, comment on Twitter, and I can address those questions in real time. These questions I'm going off of now have been submitted via people just from my social media, podcast, newsletter, and other places. They've submitted these questions. So this question I get a lot, and it is, what is the most recommended crypto accounting subledger? So this came from either a Web3 CEO or CFO. I forget exactly who sent it, but basically they're trying to understand, if you're going to set up an accounting system, what is the go-to software? And this may not be the answer that people want to hear, but there's really no one size fits all solution, but there's many different solutions that are out there to select from that are integral to your accounting process. So the subledger industry is extremely bifurcated right now. If you go and start researching this, there's easily 20 to 30 different solutions that are out there. It sort of seems like there's new ones popping up every day. So our approach when we're working with the client is first to understand their business, their flow of funds, their wallet hierarchy, the types of blockchains that they're operating on, the nature of their overall transactions, to really get a feel for their accounting needs, both in the short term and long term. And then based off of all of these factors, we usually try to narrow down their selection of a subledger to anywhere from 2 to 4, where we'll do a deeper comparison between the features, the price ranges, and any other considerations. And then that's how we finalize a selection when we're onboarding a client. Overall, at our firm, we are software agnostic, meaning we work across a lot of different subledgers. And, we're able to, I believe, to operate on any subledger, even one that we may need to get up to speed on some of the particularities in the software, but having a fundamental understanding of Web3 accounting systems, tracing transactions through the blockchain, really enable us to remain software agnostic. And I think it's a benefit to clients, because some clients are better off on one subledger versus another. I don't want to throw too many names out there and start, promoting some and not promoting others, but, you may have one client that needs to go on Bitwave. You may have a client that needs to go on an Integral or Crypto, clients that need to go on a CryptoWorth or Entendre. There's many options out there, and they all have unique features and benefits, different asset coverage and blockchain coverage. So there's many factors you want to take into account and to make sure that someone's getting on the right software. But usually we take this approach and it's just simply not a one size fits all solution. And to just sort of drive this point home further, another thing I see is some people will believe, once you get on these accounting systems, you can just sort of plug your wallets in and then everything takes care of itself. But unfortunately, that's not the case. There's going to have to be a detailed accounting process that is established and maintained on an ongoing basis to ensure accurate categorization, reconciliation, and overall financial reporting. So it's key to make sure that you select the right software because, it is very sticky. You're not going to want to, once you get set up on a software, on a sub-ledger, just switch over to a new one. So you want to make sure that you select the right one, but then it's even more important to make sure that you're setting up the right accounting system within that software and then maintaining it on an ongoing basis. So I think that's key. Let's see here. What are the tax implications to using crypto assets to invest in non-crypto assets? So it's a good question. So anytime that you're going to take crypto and use that as an investment or spending it for any other good or service, most likely you're going to realize a taxable event there. Now there can be some exceptions to this with certain types of capital contributions depending on the overall structure of what you're investing in. But for the most part, if you're going to use crypto to purchase non-crypto assets, whether they're an investment or if they're just for purposes of just spending your crypto on something to buy, those are going to be taxable events. So that is going to create accounting and tax needs when you dispose of that crypto for any other asset. Now, depending on what that asset is that you purchased, there can be other considerations, but it's going to get somewhat open-ended at that point. But I think it's important to just keep in mind that when you're disposing of a cryptocurrency, it's highly likely there's going to be a taxable event, and you're going to want to account for that appropriately and report it for taxes appropriately. So then the next question I have here is, what are your thoughts on the potential of cryptocurrencies and digital assets to be used as a tool for tax evasion? So, I saw on Reddit just maybe like a day or two ago, someone still on there saying, just contemplating if they can commit tax fraud because they're only using non-custodial wallets. It's hard for me to believe that this is still a narrative that exists because I've been sort of battling this narrative since around 2016. And although we've seen this industry mature a lot, there's still people that believe that cryptocurrency is an effective tool for tax evasion. Now, I think, going back to the first question, if you ask this individual, Frank Algren III, who's been indicted for crypto tax evasion, I'm sure he would recommend against it at this point, given the scenario that he's in. And I think we're going to start to see a lot more people get into that scenario. It's going to build up awareness for the fact that crypto is not a good tool for tax evasion because it's on a public immutable ledger. All of these transactions are going to exist in perpetuity. And many people believe just because, they're transacting on a non-custodial wallet that they're anonymous. But really, you're not anonymous. Your wallet address has all of your transactions associated with it. And that wallet address is not anonymous, it's pseudonymous, meaning that there's no identity directly connected with it. But all the IRS or any other taxing agency has to do is connect your identity to that wallet, and then you're going to be on the hook for all those transactions. Now, you see the IRS collecting massive amounts of data related to cryptocurrency transactions. One example are the John Doe ones that we've most recently seen with Kraken. And when they collect that transaction data, it's getting all of the transactions that are associated with you, and that includes your transfers to your non-custodial wallets. So I think people, because cryptos was in its early days and all these people are online promoting tax evasion, people think that they can get away with it. But eventually these transactions are going to be tied to your identity. And if you are significantly underreporting your taxes, you're going to potentially have an extended or unlimited statute of limitations where an audit can be pursued against you. So I think that crypto is not a good tool for tax evasion, although there is this perception somewhat across certain groups of people that it is. And I think we're going to, again, like with a lot of the headlines that are going to come out with more tax enforcement this year and beyond, I think that sentiment may start to shift, albeit it may be slowly. So then this other question kind of builds on that. What are my predictions for the future of crypto taxation? So I guess I'm kind of hitting on this already. I really believe that tax enforcement is going to be a huge theme this year. I recently have seen reports that the IRS is planning to send out well over 100,000, I think around 125,000 collection letters to high income taxpayers that haven't filed their returns for the periods of 2017 to 2021. And they're going to be specifically targeting non-filers that they believe are non-filing with crypto transactions. So we're going to see the enforcement. We're also going to see more data collection from the IRS. Now, they've been building up data collection on all these crypto transactions for years now. That's what we've been seeing with the John Doe audits, with some of the new regulatory requirements they're trying to implement, with the J5 international information sharing agreements, and just with a lot of the reporting requirements they've placed. That has been them collecting data, establishing questions for you to respond to that are going to extend your statute of limitations. And now they're making pushes for further compliance, targeting the taxpayers that they believe are non-compliant, and going to start to send out notices, and there will be more future tax enforcement related to this. So that's really where I believe things are going, is going to be increased tax enforcement, and the IRS really just trying to close this compliance gap. Because if you go to the IRS's website, they'll state themselves that they believe there's only a 25% compliance rate among taxpayers that should be reporting their crypto. So in other words, there's a 75% non-compliance rate. And what they're basing this off of is all the information that they've collected from exchanges and from all these other data sources that I've described. So now they're starting to slowly get into position to where I believe they're going to start enforcing this in a much more aggressive manner. We also have seen recently they've hired in more crypto experts at a leadership level into the IRS with former people from Binance and one other big crypto company that's escaping my mind right now. But there is going to be a heightened focus on crypto taxation, and specifically on enforcement to close that gap. Even just outside of this federal enforcement, I also think that 2024 is going to be a year and beyond this as well, where we see more states actually start to focus on crypto taxation. And both investors and companies are going to have to ensure that they're in compliance, not just at the federal level, but at the state level. And that is related to not only income taxation and capital gains taxation, but also sales taxes at the state level. So I think we're going to see a lot of enforcement this year, and of course more data collection, and hopefully some more clarity around the future regulatory requirements as well. Okay, so this question I'm getting is, what is the most common crypto tax mistake that I see clients make? It would be tough for me to name one, to be honest with you. Well, we're at the cusp of another bull market right now, or some may say we're in one right now. So, one thing that I see each cycle are people that are going to, as we are entering euphoria, the market's going up, everyone feels like the prices can't go down, and you'll be maybe taking profits from altcoins into Ethereum or into Bitcoin or into other large caps, or you may be a business that's earning in Ethereum or in other crypto assets for whatever the service or good or product is that you're providing. What I see happen during each cycle is when people are taking profits or earning income in a crypto asset like Ethereum, they just hold all of that value in that crypto asset. They don't take the time to do their accounting and do a tax projection and estimate their tax liabilities for quarterly tax payments. The reason why this is important is because you don't want to expose those tax payments to the validity of the market, because regardless of how good you're going to feel at the peak of all of this, eventually around the corner, there will be another bear market. And that bear market may very well come right before tax season. Because I've seen this happen multiple times in different years. Now, if that bear market comes at the wrong time, right before you're going to have to go ahead and pay a big tax liability that you've been deferring paying all year, and you're planning to pay that out of, say, Ethereum, and Ethereum drops by 50%, you're going to get stuck in a position where you have to liquidate double the amount of that Ethereum or whatever crypto asset just to cover your tax liability. Needless to say, this can completely kill your bottom line. It can blow up your portfolio or just kill your company's profits and cash flow. So you always want to be careful on estimating your capital gains, estimating your income taxes, and putting those tax payments aside and not exposing them to validity risk. That's a big mistake I see. Look, usually when someone comes to us, they're going to also have to get caught up on their accounting just because they let it go for too long. They sometimes have been neglecting it for years or months. And a lot of times, if that's the case, if we're going back very far in the accounting, which is necessary to get your cumulative cost basis information correct, there can be data gaps. And if there's data gaps, it's going to negatively impact your taxes because it's going to prevent you from being able to substantiate cost basis potentially for assets that you're selling. So it's very important to just stay up to date on your accounting and on your documentation. If you're using some obscure exchange, download the transaction details from it when you're done using it. Even if you're using larger exchanges, download your reporting from those exchanges monthly or quarterly, depending on your activity level. So you always have a backup of your transaction details and you're not stuck trying to hunt down a defunct exchange 3 years from now to get your transaction records to substantiate a cost basis on some obscure crypto that you purchased. That's another big problem that I see people run into. And two more I'll give are sort of on the sort of due diligence side of things. One being tax related, to where I'll see a lot of outrageous positions that clients will take either on the advice of other CPA firms or just based off of their research, where there's a lack of clear understanding on the nature of the protocols or transactions or assets that they're transacting in and how that relates to the tax code. And then what can happen are these really bad tax positions that get taken that can just really get complicated and create huge tax issues that have to get unwound for over multiple years. Similarly, another issue that I see, and this is a really big issue because a lot of times, and the issue is basically lack of due diligence around the accounting, specifically comparing your calculated detailed ending holdings to your actual ending holdings. For some reason, I'm seeing this go overlooked industry-wide. And this is, this goes for sometimes when people are coming to me and they've done the accounting themselves, but also even, they're coming to me and they've paid other firms to do the accounting. Somehow this is still going overlooked, which is shocking to me. But basically, if you're going to have your cost basis over or understated for any asset that's in your calculated ending holdings, that's indicating discrepancies that are potentially there in that current year calculation, but also in future years. And one thing I see basically every week when people are coming to Camuso CPA is, they maybe at this point now they're like, hey, I used another firm for a couple of years, or I've been managing my accounting myself for a couple of years because it was easier. Can we roll over everything to Camuso CPA and have you start managing our accounting? Which the answer is yes, but the first step that we're going to have to take is verifying the accuracy of your closing positions from the prior tax year that you've calculated, because those are going to be your opening positions that we're going to use as our starting point for the current year calculation. And what I'll inevitably find sometimes is they won't even have the reporting for their ending cost basis information sometimes. And when they do, a lot of times it's going to be inaccurate because there was never any due diligence done around it. And then it becomes this whole conundrum where now, we're going to have to go back and we're going to have to fix all these prior years, or you're going to have to go back and fix them before you can even get started on your current years. And then the fact that there already is inaccuracies in the ending cost basis usually leads to deeper discrepancies in the accounting and tax reporting once we reconcile everything and get it appropriate, which can lead to them having to file tax amendments and having more issues related to that. So you really want to watch out for the accuracy and the due diligence on your accounting. So this next question kind of ties into this a little bit, I think, and that is, what are some common red flags to look out for when choosing a crypto CPA? There's quite a few. I'm not going to be able to get to all of them to help you avoid every pitfall, but if I was interviewing a crypto CPA, I would want to first ask them questions to understand how reliant they are on one specific software, and if they're just sort of blindly plugging a software that they've partnered with, or do they fundamentally have an understanding of blockchain accounting, how to trace transactions through the block explorer, the due diligence steps that are necessary to ensure an accurate portfolio calculation. And that would be one of the first things. The next thing, I would really want to get a deep understanding of what their due diligence process looks like to ensure the accuracy of the accounting. There's many due diligence checks we would want to consider, but one of them would definitely be what I was just explaining with the actual cost basis compared to calculated. And another big thing I think is important is understanding their pricing structure. I would be pretty wary to get on an initial consultation with the CPA and just get pushed into a retainer, and then I turn over all of my transactions to them and start the accounting. Because there's the risk that you can get into the retainer, use it up, and then start to see that there's data issues and other unforeseen problems within your transactions that are going to require additional fees. The way we avoid that at Camuso CPA is, after our initial consultation, we review your transactions and your flow of funds to provide you with an upfront quote based off of your transaction details. So then there's no surprises on either end. So I really think it's just about, paying attention to due diligence and then understanding the pricing structure, and just making sure that they have a fundamental and deep understanding of blockchain accounting, as well as if you're an investor, the specific protocols and assets you're investing in. And if you're in a Web3 business, you want to make sure they have a fundamental understanding of your specific business as well. I think those are the big ones. I'm sure I left some out. So. And, one other point I'll add to that is I am having people come to my firm every week where, they're just dismayed with the quality of advice or accounting that they've gotten from other firms. So there are many firms out there that are doing a great job, but it also needs to be acknowledged that crypto accounting is extremely complex with a very big learning curve, and there's a huge void to be filled in terms of, people being able to provide services in this space. So with a lot of firms rushing into the space, some are going to be able to do a good job and some aren't, and that's just going to be based off of all of their firm processes and their understanding of the industry and of accounting and taxes. So this next question is, can you explain NFT sales taxes that you've been posted about? So yeah, I'll get into this briefly because I don't want to have this Q&A go on for too long. But with NFT sales taxes, to me, this is going to be a huge emerging tax issue that's going to start to take center stage as we move forward. I think potentially in 2024, possibly beyond. In a lot of ways, it feels like crypto taxes in 2016 to me, because almost no one's aware of the fact that many Web3 companies, NFT artists, and marketplaces should be collecting and remitting sales taxes for NFTs that are being sold. And right now, if you're purchasing NFTs, you're probably aware of the fact that these aren't being collected. I have probably like 50 videos on my YouTube channel on this topic. I have a book out on this topic called Wayfair 2.0 for Web 3.0. Check that out on Amazon. So I'm not going to get into all the details of it now, but I think the big things to understand about this is that it's industry-wide issue, because there's a higher level of non-compliance and lack of awareness around this than just general crypto taxes. And there are some fairly big roadblocks that are going to present themselves as companies try to move into compliance. And also even for the regulators, as they try to craft guidance around this that is going to lead to companies getting into compliance. So it's a topic that is top of mind for me, that I'm highly focused on. And I think it's going to be a huge issue moving forward, particularly because in states where we have seen NFT guidance, NFTs are getting included into existing definitions of digital products and goods, which is creating this retroactive tax exposure for people that have sold NFTs within these states. So it's a huge tax risk to anyone that is selling NFTs now or has even sold them in the past, due to the retroactive nature that can be applied here in several of the states that we've seen give guidance, such as Washington. So again, this topic is top of mind to me. And I have whole entire video after video after video on this topic, so I'm not going to belabor it too much for the sake of this, because I'm really just trying to stay on high level questions. But if you're selling NFTs, reach out to me, because you need to work with someone that understands this, that is going to get you into compliance. And if you're buying NFTs, get ready in the future, because once the industry gets into compliance, it's not going to be uncommon to have to pay sales taxes on your NFT purchases, depending on the sourcing of the sale and where the seller of the NFT is and you as the buyer are located. And that's going to be one of the big roadblocks for NFT sales taxes, is the data collection that's required for an accurate tax calculation is going to clash with the desire for anonymity and pseudonymity in this space, especially when it comes to non-custodial wallets. So this is another, I think, important topic. I think it's going to tie into the lack of due diligence, bad tax advice, and increased risk for audits in the future for a lot of taxpayers. And the question here is, can I explain FIFO versus HIFO? And I got this question from someone on LinkedIn, because I have been posting about this quite a bit. And basically, the default accounting method for cryptocurrency and digital assets is FIFO. The HIFO method is not a method that's even listed to be permitted. You either have to use FIFO, and if you meet certain requirements, you can use specific identification. So right off the bat, when someone's saying that they're using HIFO, technically that's incorrect. They're using specific identification. And to me, when they say that they're using HIFO, it's sort of a red flag to me, because that's telling me that they're probably going into an accounting software, importing all of their trades, clicking on HIFO, and then just reporting their transactions based off of however the software is going to match those up. The reason that I believe that's problematic and going to create a tax and audit risk for anyone that does that is because the on-chain flow of funds often is not going to match the actual reporting and audit trails that they're building when they're selecting HIFO. Meaning, they may have been purchasing across many exchanges, many wallets. You dump all that transaction information into software, you select HIFO, and then, based off of highest in, first out, it may say, oh, this asset you sold on Coinbase, or this asset that you sold on Coinbase, the cost basis is being applied from an asset that you purchased on Binance. Now, if you didn't, in fact, take the asset from Binance, transfer it over into Coinbase, and be able to track all that for that specific asset, show the flow of funds, and substantiate that in your audit trail to the IRS, you have to default to FIFO. And a lot of times what I'm seeing is people are selecting HIFO across their whole entire portfolio, but really all of their on-chain fund management isn't matching their tax reporting. And I think this is going to cause a huge issue when and if they do get audited. So obviously the lowest hanging fruit for the IRS right now are non-reporters, but I believe the second biggest lowest hanging fruit after that are going to be people that are applying the incorrect accounting method, because all it really takes is a tax notice to be sent out, your accounting method to be verified via that, and then they're going to know what accounting method you're using, and they can choose to scrutinize it further. Also, a lot of people like to say to me, well, I on my tax return I'm not reporting my accounting method, but it's easy for me to look at your form 8949s if you're selling an asset across several time periods, and sort of backtrack into what method you're using just based off of the dates that are presenting on it. So ultimately, industry-wide, there's a percentage of people that are claiming HIFO under the guise of specific identification, but their on-chain management of funds is not matching the audit trails that are getting built in these softwares for HIFO, and it's going to cause a huge tax reporting issue. That's why, our firm has always taken the position that our clients are filing on a FIFO basis, unless there's a specific exception to that, where they have managed their funds in such a way that certain assets were purchased and segregated into wallets that allow us to track and trace the transfers and specifically identify when they're selling that particular asset. If you're just generally taking a bunch of exchanges, wallets, and just, moving funds around, mixing them all together, the chances that you're going to be able to accurately apply specific identification, I believe, are low. And if you're just looking to take HIFO across the board for all of your assets, the likelihood that that's going to be accurate is extremely low. So I haven't really seen any cases for audits on this yet, but I was reading like a report or a white paper from Deloitte from their digital asset practice and their tax resolution practice. They had some professionals write it together, and they indicated that in some audits they have seen that as one of the main inquiries is the accounting methodology and substantiating the audit trail that they reported for HIFO or for specific identification. So I believe this is going to be a bigger issue as we move forward as well. So another question here is, as a crypto CPA, what advice do you have for aspiring individuals interested in specializing in this field, and what skills and knowledge are essential for success? So, there's a lot to learn. The learning curve is huge. I have been lucky enough that I got started in this field early with an extremely strong financial accounting background, and I've just been able to grow with the space as the layers of complexity have been built over time. But someone that's walking into it now, you're going to have a big learning curve. You're going to have to understand just the basic taxation of crypto, DeFi, NFTs, Web3. So, really, I believe in starting from, the fundamental guidance that we have from the IRS, but you need to also start following all of the regulatory changes. Usually I do that by staying on top of news alerts and subscribing to different types of tax publications. Another great way to stay up to date is by following my podcast, The Financial Frontier. I'm constantly taking all the research that I'm doing every week and talking about it on the Financial Frontier, and then also stuff that I can't cover on that, I put in the Digital Asset Digest to go into even more detail on some of these regulatory topics. So you need to get that fundamental understanding, and then you need to start to learn more about the industry and like all the different protocols, all the different business models, the different asset types. And there's a huge learning curve. You're not going to be able to learn it all in one day, but just getting involved yourself in this industry, transacting on chain, seeing the flow of funds, and then you have to continue to stay on top of things. So I guess there's not one real easy way, because you're really, like my podcast is titled, On the Financial Frontier. You're at the intersection of new financial models, new business models, new ways to do accounting, and new tax issues and questions that a lot of times haven't been addressed yet. So it is extremely challenging, but it's extremely rewarding as well. So I really think, start from a fundamental perspective and slowly just build your knowledge and try to get tapped in as much as possible to the latest regulatory changes. I think another very important thing is networking with other professionals, both formally and informally, other professionals that are involved in this space, in the tax, accounting, legal, AML. Having that network of people can also keep you tapped into a lot of the changes and emerging trends in the industry. So there's not sort of like a one size fits all approach. If you're going to be successful in this space, you have to be extremely hungry for knowledge and just extremely passionate about Web3, taxes, and accounting. But again, it's extremely rewarding. So I encourage you to sort of embark on that. So I think those are the majority of the questions that I wanted to really hit on today. Although, honestly, I have a bunch more here that I'm just not going to have the time to cover. So, this wasn't the first AMA, and it's also not going to be the last, because I probably have a whole set of questions here where we could do a whole nother session of this. So look out on LinkedIn, look out on Twitter, YouTube, or also, I'll send announcements via my podcast and my newsletter for the next AMA, and be sure to sign up for that, because there's a lot more that we can discuss here. And if you're looking for a experienced crypto CPA firm, whether you're a digital asset investor or a Web3 business and you need accounting systems established and your taxes managed, reach out to me and my team. You can contact me at CamusoCPA.com. We'll set an initial consultation with you so I can speak with you one-on-one and get a deeper understanding of your tax and accounting needs to see how we can help you. Also, visit my profile on LinkedIn, on Twitter. Just look me up, Patrick Camuso, and you can shoot me a message there, and we can start a conversation that way as well. So to everyone that's been watching, I really appreciate it. I hope that I was able to answer your questions. If you were, hoping that I was going to, get to your question on this list here today. If I didn't, shoot me a message and I'll put it at the top of the list for this next AMA, or I'll even answer you directly if it's sort of a pressing question for you. So again, if you want to get in contact with me directly, visit my social media profiles, visit my website at CamusoCPA.com, and be sure to sign up for our newsletter, the Digital Asset Digest, and tune into our podcast, The Financial Frontier. Until next time, I'm Patrick Camuso, signing off.